Good afternoon, everybody. Uneducated Economist here. Got a couple of links I want to share with you guys. One of them is an article talking about the record number of bond defaults that are occurring in China right now. And now this is something that we had talked about. China said that they were going to reel in the irrational exuberance, that they were going to allow corporations to default, that they wouldn't come in to bail them out. These are the state-owned enterprises. These are like the corporations owned by the Chinese government, and they are not bailing them out. And now this is something to think about because a couple of things have been. These Chinese corporate bonds, a lot of them were in US dollars, meaning that they borrowed in US dollars and they're owed in US dollars. And over the last few months, the Chinese currency had been strengthening, which you would think would make it easier for these corporations to pay their bonds. Like, they're able to get more US dollars for their currency. So if they're able to get more US dollars for their currency, then they should be able to pay these bonds back a little easier. But if you're a zombie corporation and you were never going to exist anyway, unless you can gorge on incredibly cheap debt, as the interest rates go up or the monetary tightening is taking place, it makes it ever more difficult for you to borrow money. And if you are a zombie corporation, borrowing is critical because the moment that you can't borrow, you start to go into default. And that's what China is experiencing right now. And I feel that this could lead to some contagion. I mean, there was investors all over the world who were pouring into China over the last year or so because they were the first ones to, end the lockdowns, the first ones to open up, the first ones to start, increasing their, having their economy growing. And so there was a lot of investors who saw this as a potential place to get a return, and they were moving their money into China. But now these defaults are hitting at a record pace. So could this be contagious throughout the rest of the world? It very well could be, and it's something to definitely keep your eye on. Now, the other article, this is quite opposite, because here in the United States, what they have is high-yielding junk debt, these junk bonds. And you think about it, they call it high-yielding junk bonds because the chances of these corporations defaulting is very high. And so the reward that an investor would get for that is a much higher yield than anywhere else in the market. Well, not anywhere else in the market, but considering the rest of the debt market out there when it comes to like U.S. treasuries or whatever, municipalities, high-yielding corporate debt is going to pay you the most, and you're going to take on the most risk. But in this article, you're going to see that high-yielding corporate debt is now paying, the yield on it is now under that of inflation. That is very, very odd to me. That an investor is willing to hand a corporation money knowing that even if the corporation paid back and didn't default, that what they got in return would have less purchasing power than if they just spent it today. It's like a guaranteed loss. And unless interest rates go down into the future, like the yields continue to drop into the future, that bond is not going to yield that investor any kind of profit after inflation. But if the interest rates do drop, they'd be able to sell it for a profit. So the investor is thinking one of two things. Either one, they don't fear inflation and they don't think that it's coming, right? So by the time they get paid back the maturity on the bond and everything, they'll have a more purchasing power in the future from this bond than they will if they are just to spend the money today. So they feel that the purchasing power of the dollar is probably not going to inflate away if they're willing to buy this corporate debt that yields under inflation. Does that make sense? So either they don't fear inflation or they think the interest rates are going to be dropping into the future. One of those two things. Now, I got to thinking about this a little bit, and I'm like, man, it still doesn't make sense to me that an investor would be willing to tie their money up with a risky corporation, knowing that the yield on it is not going to beat inflation. It just didn't make sense. So I got to thinking about it a little bit more, and I thought, is it possible that these corporate debts are going to be collateralized? I mean, you think about it, like the collateralized loan obligations that are out there. These are like loans going to corporations when they typically can't get a loan anywhere else. And then when you take these loans and you securitize them, well, then the people who bundle these things up and securitize them, they can cut them up into different tranches. So basically, you got a grade A, triple A, double A, single A, and then downward. And when the payments from these loans start coming in, the first tier gets paid first, and then the following tiers after that. So it's a way, and then these tiers, I mean, they are graded AAA. So typically, like somebody who is limited on what kind of investment grade that they can buy, you might be limited to, like, say, a grade A investment. Well, these corporations and these collateralized loans, like, they're not grade A. So typically, like, pension funds and stuff like that would never be able to buy into these corporations. But if they collateralize those loans and they put them into a security and they chop them up into different tranches, well, then they can have a grade A in there, which can be sold to, say, like a pension fund. And this is the way that a pension fund can end up loaning money to a corporation, which typically they would not be able to lend money to, because that particular corporations are not grade A themselves. But if you securitize their debt with a bunch of other ones, well, then you can create a grade A investment in there. Does that kind of make sense? Almost makes me wonder if something like that isn't happening inside of the corporate debt market right now. I mean, I don't know that. I couldn't find any articles on it. But that would make the only sense to me why investors would be pouring into corporate debt in such manners. I mean, I guess there is the idea that, the Federal Reserve might be coming in to buy the corporate debt, like they said they were going to, but never really did. I mean, they bought a little bit of it, but really it was more the credible threat that they were trying to establish to get people to go into buying corporate debt, which it totally worked. But this is a little different. This is something strange going on here, because like I said, I mean, unless it's something like I said, unless they're like, collateralizing that corporate bond and then trenching it out, I just don't see why in the world there would be so much demand for this high yielding junk bonds. Anyway, wanted to run that across you guys, see if maybe you know a little bit more than I do about that. Uneducated economist, you let me know.